Hello, welcome back to the show. So in today's video, I'll be talking about the best recent Warren Buffett buys in his portfolio today. So in today's video, we'll be covering a few things. We'll be covering the metrics that Warren Buffett uses to buy his stocks, some Warren Buffett buys, as well as some questions that you guys have left me in the comment section below. So the first metric that Warren Buffett looks closely at is something called ROE. So he wants ROE on his companies. He wants high returns on equity. So high returns on equity basically measures the returns that your shareholder equity generates. And for Warren Buffett over here, what he wants is his ROE to be above 15% over here with minimal increases in debt. Because if you increase the debt, what happens is your equity will drop and that will inflate the ROE for all these businesses over here. So for Warren Buffett, he wants companies to have higher ROE so that it basically generates high returns for all its equity holders. And this is one metric that you can look out for when it comes to filtering out your stocks. Next one is a low valuation. So generally, Warren Buffett, he's a deep value investor. What he wants is to buy companies at a discount, and normally the discounts come when the companies are trading at a very cheap valuation over here. So for example, Warren Buffett, he typically buys companies below 20 times earnings. So he bought Apple at around a 15 times earnings. He bought Coke at around 18 times earnings. He bought See's Candy as well, which is a private company now, at 6 times of earnings. Third metric that he looks out for is something called high returns on tangible assets. So your tangible assets is basically the physical assets that the company owns, not your intangibles. So your intangible includes your goodwill, your brand name, and all that. But for Warren Buffett over here, what he wants is companies to basically have high returns on tangible asset, which measures the abilities of all these different companies to generate returns on physical assets. This metric over here is typically used for all your different businesses that are highly capital intensive. So your return on your tangible assets is your net income divided by your tangible assets. And what Warren Buffett wants, similar to your ROE, is for your ROTA to be above 15% or so. So the first company that Warren Buffett has bought recently is Dominos over here, the pizza company that everyone loves. So for Dominos over here, this is their business model. They are a franchise business model, and what they do is they act as a middleman. So they basically license out their brand name to all your different franchisees over here, and then they just collect a fee from them. Typically a recurring revenue that comes in every single month from all these franchisees. And what they do is they link the supplier to all these different franchisees, and then they just sell the supplies to them at a higher price. So for Domino's business model over here, it is similar to what McDonald's adopt as well. McDonald's is trying to shift towards a franchise model as well. And for Domino's over here, they have above 90% of their business under this franchise model over here. So for Domino's over here, if you were to look at the metrics, for example, the ROIC is at around 131%. So normally for your businesses, what you want is you want high ROIC. High ROIC is the return on investment, meaning to say it measures how well a company is able to deploy capital into investments to basically generate returns. And for Domino's over here, despite the high debt, this company is still able to increase its ROIC over time. The ROIC is at around 131% over here, which is quite incredible for this business. It shows that this business is an asset-like business and it is able to generate returns on its investment over here, which is typically what you want for all different companies. But the problem with Domino's over here is simply just the sky-high debt. So for this company over here, its debt to EBITDA is currently now at around 5 times. Normally what you want for your debt to EBITDA is for it to be less than 3 times. And for Domino's over here, if you're to look at all the different bonds that they have, a lot of them is maturing in 2025, and the current interest rate environment is still unfavorable as compared to the past 10 years or so. We're still at a 10-year yield rate of around 4.5%, which is higher than historically over the past 10 years. And so for Domino's over here, they're going to have to refinance their debt at a much higher interest rate as compared to previously, which could weigh on their margins over time, because when you have to refinance your debt at a higher rate, and what happens is a lot of your earnings will be attributed and will be basically paid for your interest payments over here, which is typically what you don't want to see. It drives down their net income margins over here. The next problem with Domino's is simply just the consumer weakening. So over the past year or so, the consumer in the US has been weakening, partly because of the tariffs as well. And for Domino's over here, it has a lot of its imports coming in from India as well, which is a highly tariff state, although they're working out a deal already. So for Domino's over here, after all, they're still a retail business, so it is subjected to retail weaknesses over here. Next stock that Warren Buffett owns is Verisign. So Verisign is an incredible company. I've looked at this one before. So Verisign's business model is this. What they do is they sell all your different .com and .net domains. So for every single company that wants a .com or .net domain, it has to go through Verisign. And for Verisign over here, they control around 80% of the market share in terms of your website domains, and they are essentially a monopoly at this point. So the only competitor to Verisign is your .xyz, your .sg, your .cn, all your different country domains over here. So for Verisign's metrics over here, as you can see, the net income margin is extremely high. So the net income margin is at around a 50%. It is almost similar to Visa and MasterCard already. It is an incredibly high margin business, which signals a strong moat in this sector over here. And Verisign's ROIC is also quite high as well. It's at around a 40% or so. Typically for your ROIC, as long as it's above 15 to 20%, it is considered quite high already. Verisign has around a 40% ROIC over here. So for Verisign over here, there are multiple different secular growth trends. So there's digitalization, which leads to more website requirements, as well as higher tech usage in all the different third world countries as they try and transition from a non-digital world to a digital world, which will lead to more website domains being built over here. But for Verisign over here, here are some of the problems that I see with this business. This business is trading at a high valuation. So this year alone is up around 35% year to date. It is currently now at around a 35 times earnings, which is quite high considering the company traded at around a 28 to 27 times earnings just a few months ago. Verisign over here has slowing volume growth in terms of its website registration. So because of the Chinese weaknesses over there, the China website registration has gone down, and that led to Verisign having a negative growth rate last quarter as well. And for Verisign over here, they simply have no more pricing power in the next 4 years or so, and the returns are likely priced in already at its current price because they have an agreement with ICANN, which is a government agency, which prevents them from increasing prices for the next 3 years. They can only increase prices of all the different website domains in the remaining 4 years that they have at the tail end of their contract over here. So you can expect the next 3 years to have basically no increase in terms of its revenue unless they increase the volumes of all these different websites over here. So there's currently no pricing power, but there's an incredible moat in this business over here. But at its current valuation, I don't think it is a buy today. Warren Buffett bought at around $200. Currently now it's at around $280 or so. Third stock that Warren Buffett has been buying heavily into is Pool Corp over here. So this is Pool Corp's business model. They have a monopoly in pools. They sell the pools, they maintain the pools, they sell the chemicals to maintain the pools, they sell the software to connect people with pools to maintenance companies over here that will service all these pools over here. So for Pool Corp over here, there's a problem with this business. It is simply just the slowing down of growth after its initial stimulus check jump. So post-COVID over here, which is at around 2021 or so, they had a quick spike up because a lot of people, they had stimulus checks to go and buy all these non-discretionary items, and so they bought a lot of pools. And currently now we're seeing a pullback in all the spendings over here simply because it is just a reversion to the mean over here. And for Pool Corp over here, the business is slowing in terms of its revenue and they over-earn post-COVID over here. We're seeing some form of normalizing, and over the past 8 quarters or so, this company has just seen decreasing revenue almost every single quarter. So for the long-term trend for Pool Corp over here, in the long term, people won't stop buying pools. There's a secular growth trend with increased digitalization and increasing of wants and lavishness. So I don't expect the pool demand to slow over the next few years or so. In fact, I expect the pool demands to continue increasing over time as people become more lavish and as wealth increases over time. So for Pool Corp, I think it is a high quality business, currently not trading at a cheap enough valuation yet for me to want to enter. And overall, this business is quite a monopoly, and I will likely look into this further if it trades at a lower valuation. Fourth stock that Warren Buffett has been buying heavily into is this company over here. This company is SiriusXM. So this is SiriusXM's business model. What they do is they are a satellite radio company, and every car in the US will be fitted with some form of satellite radio service. And even your Tesla cars today, they have SiriusXM services over here. They are a monopoly in your radio service portion over here. So my problem with SiriusXM is this: it is in a sunset industry. The radio industry will likely fall over the next few years or so. So you have companies like Spotify, YouTube Music, Apple Music, all these different companies trying to steal market share away from SiriusXM. And over the next few years or so, give it 10 years, 20 years or so, you will likely see SiriusXM's market share going down and down and down almost every single year. And they have been experiencing decreases in their subscriber growth over the past few years already. So another problem with this business is simply just the high debt. So they have to shoot up satellites every once in a few years, and that is extremely capital intensive. But this is what Warren Buffett likes about SiriusXM. So SiriusXM is simply just a cigarette butt play that he typically does. It is a company that's trading at 13.5% free cash flow yield. So currently now at between a 7 to 8 times price to free cash flow, which is quite incredible, with a 4% dividend yield and a 31% payout ratio. So they can increase their dividend yield by around 3x and basically just pay out 100% of their free cash flow growth, and there's a 10% return from this company over here. It is a deep value play at this price, and I think it is one that could pay off in the future, but currently I'm not actively investing into this one because I want my businesses to be high quality, and SiriusXM is simply a company that is in a decline over here. But no doubt, this company is a deep value play, and if you're a deep value investor, then this company could be one that you would like to look at. Last portion over here, I'll be covering some of the questions that you guys have left me in the comment section below. So the first question over here, it says, also as a Singaporean yourself, what do you think about Grab? So Grab is a company that is quite famous in Singapore. It is a widely known brand in Southeast Asia itself. But for Grab, the problem is this. There is no competitive advantage in terms of Grab. You have other ride-hailing companies in Singapore, for example, you have Tada over here and you have Gojek over here as well. And then in other Southeast Asia companies as well, there's Uber that's competing with Grab as well, although Uber owns Grab. And so for Grab, I don't think it is a multi-business. It is a company that is not high quality enough, and there is a lot of competition in that space. So that's one problem with Grab over here. The next problem with Grab is simply just the company is not yet super profitable. So they just turned profitable, I think 2 quarters ago, and currently now the company hasn't shown that it's able to basically be profitable for multiple different quarters over here and multiple different years. So typically for my companies, I want them to have a history of strong fundamentals, and for Grab, you're not seeing that now. You're seeing a company that is in a growth phase, and typically for my companies over here, I want them to be in a profitability phase rather than the growth phase itself, because the growth phase is typically when you see companies go bust, and it is not as predictable as the profitability phase over here. So I think a better play would be Uber, although Uber, I think it is a company that is quite richly valued as well. But for Grab over here, it is not in my considerations simply because the company is not high quality enough and the company is not very profitable yet. Next one over here, hi Kwan Ray. Congrats on 1K subs, thank you so much. Great content, watch every single video you produce. I assume your portfolio is all US stocks. Want to ask if you own any Chinese or European stocks? If you are, wondering if you'll be making a video on this subject. So yes, I own a European company, it is ASML. So apart from that, I don't actively own any Chinese stocks right now. I'm actively looking into some Chinese stocks over here and some European stocks as well. So for the European sector, it will be Novo Nordisk. This company has been basically on a downtrend for the entire of this year as well as last year. So this company, Novo Nordisk, it is trading at a decent valuation right now. But the problem with the business is I don't understand the business enough. So I want a very, very big discount if I were to enter into this business over here. And it is one that I'm looking at currently. Another one in China is Alibaba as well as Baidu. Baidu is a deep value play. So Baidu is currently now trading at a less than 1 times price to book, and they have around 30% of their market cap in cash. So it is a deep value play over here in terms of Baidu. They own your search engine in China, the most famous one, the biggest one, which is Baidu. They own a streaming service as well, which is your iQIYI. And then I believe they are allocating some capital into LLMs as well. And then they have a small cloud sector as well, which is growing for them. But for Baidu over here, the problem with the business is the search business in Baidu is slowing down. It is recording negative revenue growth, and it is simply just a deep value play if I were to buy into this company here. So Baidu is one I'm considering, although it is not high quality. The next one I'm considering as well is Alibaba. So Alibaba over here, it is a company that is quite high quality in China itself. They have the Alibaba web, and then you have your Taobao, you have all your different other Chinese logistic firms as well under this company called Alibaba, and they have the cloud segment as well, which is growing quite steadily over the past few quarters or so. So for Alibaba over here, it is a high quality business that is currently trading at quite a valuation already. It is currently now trading at around a 17 times price to earnings. And for me, I think maybe I'm price anchoring over here, but last year or so, it was trading at around 11 to 12 times earnings. So I would like for the company to drop back down to closer to that valuation. Currently now, it seems a bit richly valued as compared to its history, as compared to the Chinese market in general. So for Alibaba over here, I'm monitoring this company. As long as I get deep in this company, maybe I'll allocate some of my capital into this company. So I hope you guys have found this one useful and invest safe.